The government announced in the most recent federal budget that there will be changes to the corporate residency rules, which can be voluntarily retrospectively applied to the 2017 income year. These new rules seek to alleviate the debacle caused by the Bywater case. Here's a bit of background to corporate residency and a bit of history about the case. Companies are generally resident of Australia if incorporated in Australia. If the company is not incorporated in Australia, it's a resident of Australia if it carries on a business in Australia and its central management and control is in Australia, or voting power is controlled by shareholders in Australia. If a company doesn't carry on a business in Australia, it will not be an Australian tax resident, regardless of whether central management and control or voting power lies in Australia. In respect of carrying on a business, it's been a long-standing view that this means the operational aspects of the business. So if an offshore company has people on the ground, overseas running it, making operational decisions and some management decisions, etc., then it doesn't carry on a business in Australia, and the flowchart stops there. It's not an Australian resident. Bywater has completely ruined all of this by making a passing statement, which, by the way, didn't even impact the outcome of the case, that if a company's central management and control is in Australia, then it factually carries on a business in Australia. So after Bywater, if you own an offshore company which is actively operating overseas, just because you are an Australian director making strategic decisions from your office in Australia, then your company is considered to be carrying on a business in Australia, then the company is an Australian resident. This caused a lot of headaches in the market, especially in the big end of town. The ATO withdrew an old ruling from 2004 and created a new one in 2018. It provided various scenarios where the outcome has completely changed because of Bywater. Directors were like flying offshore every month to conduct board meetings. Australian directors were getting uninvited to virtual meetings or even being removed completely as directors. Some completely ridiculous outcomes. So the federal budget has introduced this new test. An offshore incorporated company will be Australian resident if there is significant economic connection to Australia. The test will be satisfied if core commercial activities are undertaken in Australia, rather than carrying on a business in Australia under the current rules, and central management and control is in Australia, which is the same as the current rules. It's unclear at this stage what core commercial activities actually mean. Does it mean if more than 50% of commercial activities are carried out in Australia, then this is satisfied? Also, what's the meaning of commercial? And how does it apply to, say, family groups who are merely investing in passive assets, such as shares and real property? The Board of Taxation report called Review of the Corporate Residency Rules, of which the government has based its announcement on, sheds some light on this. I'll take you through a couple of examples that was in the board report. Say there's an Australian holding company which owns 100% of two foreign incorporated companies, which I will refer to as offshore companies, and they are carrying on active businesses overseas. These companies have the same director who is also the owner of the Australian holding company. The director performs the strategic management of the global business whilst operational management is performed by staff in the overseas countries. Before Bywater, these foreign incorporated companies are not Australian residents, but after Bywater, these companies are Australian residents. The Board of Taxation recommends that under the new rules, the offshore companies are foreign residents because no core commercial activities are carried out in Australia. However, this situation changes if the Australian director performs both strategic and operational management of the offshore companies. For example, contract negotiation for routine trading transactions, procurement decisions, and staffing decisions. Under the new rules, the board has recommended that the offshore companies are considered Australian residents because core commercial activities are in Australia. This means that core commercial activities will very likely include operational management. If operational management is occurring from Australia, the offshore companies are Australian residents, even though there are no Australian assets or Australian sourced income being generated by the offshore companies. According to the board, This is the same outcome that would have arose before Bywater and under the tax office's 2004 ruling. In essence, I think basically the old ruling from 2004 will be effectively reincarnated, except instead of carrying on a business, the test is now or will become core commercial activities in Australia. But what about passive offshore companies? The board report provides a final example in relation to property and investment assets held in an offshore company. In this example, the directors are always in the foreign jurisdiction conducting meetings, but all decisions, both strategic and operational, are only effective if the ultimate beneficial owner agrees to them under the company's constitution. All tentative decisions that are made by the directors are forwarded to the ultimate beneficial owner for review and approval. The board, of course, recommends that this offshore company is an Australian resident. So the conclusion is for private or family-owned offshore companies holding offshore assets is that these companies will be resident of Australia if it can be proven that the Australian beneficial owners actually exercise decision-making at both the strategic, which is central management and control level, as well as operational level, which is the new core commercial activities test. The new rules will unlikely change this regardless of the fact that all assets are offshore or that no Australian source income is being generated by the offshore companies. Overall, these changes are certainly very welcomed and makes a lot of sense from the big end of town perspective. But in relation to offshore passive companies, this is definitely a loss for the ATO. The ATO will need to discharge the burden of proof that the Australian ultimate beneficial owner is indeed making operational decisions for the offshore company and not merely strategic decisions for the company to be taxed in Australia. I hope you found this tax nugget useful. Feel free to drop me a line. Let me know what you think. Is this going to impact your clients a lot? Are your clients happy with it? Feel free to drop me a comment. Thanks for watching. Until next week. See ya. Bye.